Most people think they are investing in the stock market. A surprising number of them are really just standing under a machine. They do not understand. Money today is not moving the way most retail investors imagine it moves. They think capital wakes up every morning, reads the same headlines they do, compares a few valuation ratios, and then politely spreads itself across the market according to merit. That is not what I see. What I see is a river that has been engineered, and if you do not understand where the current is strongest, you can spend the next decade believing you were diversified, when in reality you were simply being dragged. That is the first thing I want you to understand. The market is not one market. It is a field of rotating pressure. Capital does not disappear nearly as often as people fear. It relocates, quietly, ruthlessly, from one pocket of the market to another, from the obvious to the ignored, from what everyone talks about to what very few people can even explain. That is why I have always believed that investing gets easier the moment you stop asking, which stock should I buy? And start asking, where is the money actually going? That question changes everything. There is a machine behind the modern market that most people never study. The machine is passive flow index funds, ETFs, retirement contributions, automatic purchases, millions of people sending money every month into broad baskets they barely understand. Because the fees are low, the process is easy, and they have been told that buying the index is the closest thing finance has to autopilot. I understand why people do it. What most of them do not understand is what that money does once it arrives. The bigger a company becomes, the more of the index it occupies, the more of the index it occupies, the more automatic money flows into it. The more automatic money flows into it, the bigger it becomes again. And once that loop starts feeding on itself, the largest companies receive a disproportionate share of new demand, whether or not they are still the most intelligent place for fresh capital. That is not a theory. That is the plumbing. So when people tell me they bought the market, I usually hear something else. I hear that they bought a system that increasingly shoves money toward the largest names, whether those names deserve every last dollar or not. Sometimes that works beautifully. Sometimes it becomes a trap disguised as prudence. I have seen this kind of thing before in other forms. Once a structure starts rewarding size automatically, intelligence often gets replaced by momentum and comfort. Investors begin believing that what has grown large must also be safest. Then they stop thinking in terms of opportunity and begin thinking in terms of familiar brands. That is usually when I get more interested in the parts no one is talking about. We are no longer living in the kind of market where you can throw money almost anywhere and let a rising tide hide your ignorance. That was a very easy environment for people to confuse luck with skill. This is a different climate now. What you own matters more. Where capital is rotating matters more. And if you keep staring at the same 10 names everybody else is already staring at, there is a fair chance you will get average results at best, while other pockets of the market quietly do the real work. I want you to think of the market the way I have always liked to think about business conditions, as weather. Your job is not to predict every cloud with perfect accuracy. Your job is to understand the season you are actually standing in and then wear the right clothes for it. And this is not the season of lazy sameness. Inflation pressure is not fully dead. Rates are not as friendly as people would like. Governments are spending aggressively. Energy security has become a geopolitical obsession. Artificial intelligence is putting new demands on electricity, cooling, transport, infrastructure, and supply chains in ways most people still underestimate. In a world like that, you should expect money to move toward very particular kinds of businesses, not because they are fashionable, because they sit in the path of necessity. That is the distinction that matters. A lot of investors want the glamorous story. I usually prefer the unavoidable one. That is where the first theme appears, picks and shovels. People know the old line from the gold rush. The fortune was not always made by the man digging. Very often it was made by the man supplying the tools. The same principle appears again and again in modern markets. The noisy story is usually downstream from the steadier economics. In energy, for example, many people immediately jump to oil producers or gas producers, because those are the names they associate with the commodity itself. But if energy demand rises, Infrastructure must expand, equipment must be replaced, machinery must be maintained, transport systems must be built, terminals must be upgraded, and whole chains of industrial support businesses start filling with orders. The producers get the headlines, the suppliers get the backlog. That is not as sexy. It is often more durable. The world needs energy in a way that is becoming less optional. Not more AI data centers do not run on inspirational quotes. They run on power. Industrial economies do not keep functioning on social media enthusiasm. They run on power when geopolitical tension rises and key routes become vulnerable. The demand for domestic production, storage, transport, and repair goes up even further. That is when the machinery businesses begin to look less like side characters and more like toll roads. I have always loved toll roads in business. A company that sells the equipment, the systems, the maintenance, the service, the processing capacity, the infrastructure, or the specialist tools that other businesses must keep buying can often live in a very attractive economic position. It does not have to be right about every commodity price every day. It only has to remain essential in a world that keeps demanding more throughput. That is why I find myself more interested in oil and gas service machinery, LNG infrastructure, compressors, pipelines, and the broad family of businesses that enable energy production than in the loudest story of the moment. The real money often moves first into what the system must keep funding. The same logic shows up in a second place, and it may become even more powerful over the next decade: critical minerals. A lot of people hear that phrase and their eyes glaze over. Good. I like it when something important still sounds boring. Boring is usually where the crowd arrives late. The modern world is becoming more electric, more digitized, more defense-oriented, more grid-intensive, and more dependent on secure supply chains, electric vehicles, battery storage, grid modernization, nuclear power, renewable build-outs, defense manufacturing, semiconductor infrastructure, data center growth, high-performance cooling, and industrial reshoring all pull on one hidden thread. They need stuff dug out of the ground: lithium, uranium, rare earths, industrial minerals, processing capacity, transport, refining, domestic supply chains. If you take a broad enough view, you see the same mother line again. The future is not just software. The future is physical. And whenever the world turns back toward the physical, the companies sitting closest to the resource bottlenecks become much more important than the public usually recognizes. There is a second layer to that story that makes it even stronger. Governments do not want strategic dependence when the strategic environment is deteriorating. A country that relies too heavily on another country for key energy inputs, uranium, rare earth processing, or adjacent materials eventually starts paying for that dependence one way or another. So capital begins moving, not just because of economics, but because of national urgency. That is a very powerful tailwind. And once again, it means the obvious winners may not be the ones the average investor first names. It may not be the most discussed electric vehicle stock. It may not be the loudest AI company. It may be the miner, the processor, the equipment supplier, the domestic operator, the service contractor, the boring capacity builder one step behind the story everyone thinks they understand. That is where intelligent rotation often begins. Now, I want to stop and make something very clear. I do not believe in blindly buying things. That is just another way to lose money with more self-confidence. The right process is not "this story sounds exciting, therefore buy whatever sits near it." The right process is more disciplined than that. First, understand the weather. Second, rank the sectors that actually benefit from that weather. Third, identify the strongest businesses inside those sectors rather than starting with individual stocks and inventing a macro story afterward. That order matters. Most people do the exact opposite. They start with a stock tip, then search for a narrative that makes it sound intelligent. That is how people confuse storytelling with investing. I prefer to begin with the broad force, then narrow the field until only the best positioned businesses remain. And then I still care about one more thing that many people dismiss far too casually: price behavior. I am not talking about superstition or fortune telling. I am talking about watching where institutions are willing to keep accumulating. A good business in the wrong environment can drift for a very long time. A mediocre business in a powerful flow can rise faster than it deserves. But a strong business in a strong sector, with capital beginning to build pressure behind it, is where things get interesting. That is why I have never laughed off the idea of waiting for evidence that money is actually moving. I do not need to buy at the absolute cheapest price in history to do very well. I would rather pay a little more for something that is proving institutions agree with the thesis than pay a little less for something that still has not attracted the kind of demand that makes the move durable. That is a very different thing. And there is a deeper lesson inside it. You are not trying to predict every stock from scratch. You are trying to follow the path of least resistance once money begins choosing its direction. That is why I say over and over that most investing mistakes are not really stock mistakes. They are attention mistakes. People are looking in the wrong place. They stare at the mega cap names because that is where the media lives. They stare at the same crowded trades because that is where conversation lives. They stare at what already moved because that is where comfort lives. Meanwhile, money is rotating from software to hard infrastructure, from narrative glamour to physical necessity, from crowded certainty to under-owned demand. If you miss those rotations, you can spend a year holding respectable looking things while truly exceptional performance happens elsewhere. This is not about becoming a trader in the cartoonish sense. It is about recognizing that the market is a chessboard, not a one-way elevator. Money moves from square to square. Energy services can lead for a period, then defense, then minerals, then insurance, then industrials, then healthcare, then something else. The key is not to marry a square. The key is to understand why the money moved there, how long the reason remains alive, and when that reason begins to weaken, that is sophisticated investing in its simplest form. You are not worshiping a stock, you are respecting a flow, and if you are doing it correctly, you are doing it with risk control. That matters just as much as the thesis. A lot of people hear a convincing idea and then ruin themselves by oversizing the position or behaving as though conviction eliminates the possibility of being wrong. It does not. A good framework makes you humble. You can scale in. You can size positions so that one mistake does not injure the whole portfolio. You can avoid concentration masquerading as conviction. You can keep dry powder. You can insist on evidence. The point is not to feel invincible. The point is to remain alive and rational long enough for the good ideas to pay. I have built enough businesses and bought enough securities to know that survival is half the edge. Now, let me reduce this to the deepest thing I want you to remember from all of this. The biggest opportunity of a decade rarely announces itself as the biggest opportunity of a decade. It often begins as a quiet rotation. Something essential starts attracting capital while the crowd is still fixated on something louder. By the time the opportunity becomes obvious enough to feel safe, a great deal of the easy money has already been made. That is why follow the money is such a useful sentence. Not because it sounds clever, because it forces you to stop anchoring on what is most discussed and start watching what is most funded. In the years ahead, I expect the winners to be less random and more tied to necessity than many people realize. Energy infrastructure service equipment, critical minerals, the physical systems required to power a more electric, more geopolitical, more resource-constrained world. Those are not memes, those are demands, and demand, when it becomes unavoidable, has a way of making boring companies look very intelligent. I have always liked being paid by inevitability. If you remember nothing else from what I just told you, remember this. The market is not paying you for watching the same names everybody else watches. It pays you for understanding where the river is quietly changing course before the crowd admits it changed at all. That is where the real edge lives. Not in guessing, in noticing, not in chasing, in ranking, not in owning the loudest story. In owning the businesses, the world is forced to keep funding whether people are excited about them or not. That is how I would think about this market. And if I were a retail investor trying to survive it intelligently, I would stop asking which stock feels popular and start asking the only question that matters. Where is the money already beginning to go?